What is going on, investors? Hopefully you guys are having a great day out there. That is right. AT&T made big news today as they confirmed the deal to merge WarnerMedia with Discovery. So we're going to talk about on today's video what this means for you, the AT&T shareholder, and potentially the Discovery shareholder as well. We'll talk about why AT&T is potentially doing this. Okay, we actually seen Verizon also unload its media assets for $5 billion last month. We'll talk about where this positions both companies now, particularly AT&T versus its rivals Verizon and T-Mobile. We'll talk about the WarnerMedia Group, how it contributed, what it contributed to AT&T's business in terms of profit. What is that going to do to the all-important dividends over at AT&T as well? And then we'll talk about their long-term debt, how this is going to restructure the company, how it's going to look compared to a T-Mobile and a Verizon as well. And then we'll also take a look just briefly at the stock chart as well, see where this one is headed. Tell you what, on the channel here just last month and really over the last year or so, we have been recommending AT&T as a buy in that low $30 range. And it looks like the stock is reacting positively to this deal, trading closer to $33 per share. Now, year to date, this stock is actually doing quite nicely, up 12%. The yield on this one is about 6.5%, probably less once you factor in today's potential gains on this deal announcement. So AT&T owns WarnerMedia, if you didn't know that already. So WarnerMedia is essentially a group of properties that AT&T acquired several years ago for like $80-something billion. So they paid a lot for this business. It includes HBO, Warner Brothers, and obviously Discovery is now going to be added into that. But you have CNN, you have HGTV, which is part of Discovery. You have Turner Sports, TNT, TBS, that's a part of WarnerMedia. You've got a lot of brands and shows that are going to be rolled up into one offerings. The terms of the deal, it appears AT&T is going to receive $43 billion. That is right, $43 billion in the combination of cash, debt securities, and WarnerMedia's retention of certain debt. So some of this debt that is on AT&T's balance sheet is going to transfer to the new company. So the way I want you to think about this, if you own shares of AT&T and even Discovery, is really parts of AT&T are going to be taken away. And you, the common shareholder, are going to get either parts of the new company. So they're going to create a new ticker symbol, a new stock. And if you own shares of AT&T, you're going to either get some shares of that company, you're going to maybe get a dividend, or possibly an exchange or a combination of both. So it could be that you get some new shares of this new company and you get a little bit of a dividend as well. So it potentially could work out in both sense for you, the AT&T shareholder. AT&T shareholders are going to represent 71% of the new company. So the AT&T shareholders would get the bulk of the shares if that is how they decide to structure this deal for the common shareholder. Meanwhile, Discovery shareholders would own 29% of the new company as well. Both boards have approved this transaction. There might be some regulatory stuff here, but my guess is this deal does get done because it does make sense and it is shareholder friendly. The other thing to think about is this should be a tax-free way for AT&T to kind of unlock the value in this business. So they're able to unload this WarnerMedia business and pay you, potentially the shareholder, an additional dividend on top of that, all tax-free. That should be attractive for shareholders. Now, the thing to think about, though, is the fact that AT&T is getting $43 billion in combination of cash, debt securities, and WarnerMedia's retention of debt. Does that mean they took a loss on this business? Potentially, that could be what that means as well. Now, why is AT&T doing this? Okay, part of it is, I think, the industry in terms of the telecom space of Verizon, T-Mobile, and AT&T here in the United States are looking at the valuation that the investors are giving to T-Mobile, okay? So we looked at T-Mobile on our channel a few weeks ago, and T-Mobile trades at a premium to both Verizon and AT&T, and it was AT&T and Verizon that owned these media assets. In the case of Verizon, they owned AOL, Yahoo, and several other kind of like websites, and they just offloaded that for about $5 billion. Obviously a much smaller deal, but that should help Verizon pay down some of its debt and reinvest in this business. So what it could mean is, here's the deal, is AT&T and Verizon could eventually catch up to T-Mobile, or potentially maybe T-Mobile comes back to AT&T and Verizon. All I know is from a price to sales basis, which I have up here, AT&T at the current moment is trading a 1.33 times sales. Verizon is 1.88, and T-Mobile, which is just your pure play communications business, is trading at over 2 times sales. So it could be exciting for both Verizon, but particularly AT&T shareholders, as they clean up the structure of their business and potentially reduce debt as well. It could make AT&T a more attractive stock, even though the combined business will likely be much smaller. Now, let's take a look at WarnerMedia. So I've pulled up AT&T's most recent quarterly report. So keep in mind, these are quarterly numbers. These are for 3 months ended in March of 31st, 2021. Here is WarnerMedia right here. It represented $8.5 billion worth of revenue. In terms of AT&T's communication business, which is what is going to be left of the business, you've got $28 billion of that business. So WarnerMedia was a fairly large segment of AT&T's business, but they're still going to be left with a very, very, very big business, and one that could be valued potentially maybe closer to how T-Mobile's is, at least on a sales basis. Now, WarnerMedia, from a profit perspective, or at least an operating income perspective, was sitting right at about $2 billion. Okay, the total communications income from operations was sitting at we'll call that $7.4 billion in the last quarter. So not quite, almost a quarter of their business was actually this WarnerMedia in terms of operating income. So a quarter, not quite a quarter, but almost a quarter of their operating income will be going off into this new company. Now, let's take a look in terms of dividends. This company paid $3.74 billion worth of dividends on those earnings. So we pulled down that net income number of about $8 billion in the most recent quarter. Net cash provided by operating activities was about $9 billion, and they paid about $3.7 billion of that in terms of dividends. Now, the other thing that they had to do is they had to service this debt. They had to pay interest on this debt as well. And so as AT&T is able to pay off the debt, this actual net cash provided by operating activities should actually get a little bit higher as they reduce their liabilities and reduce the amount of money they have to pay to service debt. So some of this, I understand that we're pulling away $2 billion worth of operating income from a segment of the business, but also keep in mind that AT&T will be saving money in terms of interest that they have to pay on the debt that they're servicing that they acquired when they bought WarnerMedia. Now, in terms of long-term debt, speaking of that, they've got about $160 billion. That is right, $160 billion of long-term debt, and they've got another 20 that is due within the next year over in AT&T. So if we assume that a large portion of this $43 billion will go to reducing this debt, or at least partially reducing this debt, that could get AT&T in a position where they're still going going to have likely over $100 billion worth of debt. In fact, there's no way around that they won't, but this will be reduced significantly, at least on the parent company that it remains for AT&T. Now, you might wonder, how does that debt level compare to a T-Mobile? Here is T-Mobile here. They're sitting at about $66 billion worth of long-term debt. So obviously AT&T still will have a considerable more than T-Mobile. Now, in terms of Verizon, you might wonder, well, how does the debt compare to Verizon? It turns out that AT&T will likely be very, very comparable to Verizon in terms of this long-term debt. Verizon has $149 billion worth of debt. And so we talked about how AT&T has about 160 of this long-term debt. You got to factor in probably, I would guess, just off the top of my head, a $48 billion deal. You got to realize or feel that at least probably 30, maybe even 40 billion of that, maybe even more, will go to service this debt or basically transfer some of this debt. Realize that some of this long-term debt sitting on AT&T's book, a lot of this, like probably about half of it, comes from the WarnerMedia acquisition. When they acquired the company, they basically financed that majority of that through some debt offerings. And so some of this will just simply be transferred over to a new company, and what remains will just simply be on the books of AT&T. And in my opinion, they're going to look a lot like Verizon. In fact, might even have less debt than Verizon. So that also brings back into our valuation in terms of Verizon's selling at 1.88 times sales, and AT&T still trading at a discount to both of those companies. Now, in terms of the stock chart, we have been bullish on this stock for a while now. It looked like it wanted to make a bottom down here in the $27, $28 range. We even liked it up here at 29. I liked it up here at 29. As we broke above 31, we actually talked about this on our most recent video of AT&T. If you broke above this $31 level, well, I tell you what, it was off to the races. You were probably coming up to these highs that we made. We had the initial kind of knee-jerk reaction from the health situation, a snap back, and then kind of a snap down with this one. We pretty much retraced back to this high of about $33.20 per share. That's about where the stock is sitting at pre-market now as we do this video. So this area should be an area of some resistance, actually right where the stock is sitting, or right about where we're sitting at right now. So here's the way I look at this chart. Now you have support down here at 31.50. If you get any pullback to AT&T, obviously there's some clarification that we would need on this deal. How is it going to impact their debt to a certain degree? Also, the dividends over at AT&T. That is the question every investor wants to know. They paid $2.08 per share in dividends, and AT&T shareholders are going to want to know, is that dividend rate, is this yield going to stay the same? And again, I talked about, yes, we are pulling out $2 billion worth of operating income and $8.5 billion worth of revenues. Again, that's on a quarterly basis. You want to annualize this out, you're probably anywhere from $8 to $10 billion in operating income. So that's a fair amount of operating income, but also keep in mind that we are going to save some money on the debt, actually quite a bit of money on the debt servicing over at AT&T, which is not an insignificant thing, to be honest with you. So AT&T does pay quite a bit of interest on their loans, and it is something to keep in mind. So I wanted to show you here really quick for the most recent quarter for AT&T. Here's interest expense, so that we talked about how we're going to shift a fair amount of their debt over to a new company and potentially put some cash on the balance sheet over at AT&T, potentially to pay off even more of this debt. Here's their interest expense just in one quarter is $1.8 billion. Okay, so we had $1.8 billion of interest expense, and the WarnerMedia Group provided about $2 billion worth of operating income. All things being equal, it looks like AT&T potentially could maintain this dividend if they are able to reduce this debt interest payment to offset the operating income that they're going to lose from the new WarnerMedia Group. Now, the last question you might have is, should you buy AT&T shares now? if you already own AT&T shares, should you keep the new shares or the new dividend in the new company? So look, I tell you what, on this, if you already have price appreciation in this one and you want to lock it in, I don't necessarily see a problem with that. Understand that you will have to pay capital gains tax and things like that on there. Typically, when these deals go down, I just let them go through and I see what my options are at a later date. So in this case, as an AT&T shareholder, I'm going to hold my AT&T shares. I'm going to wait to see what the result of this spinoff looks like. I think you're definitely going to get shares in the new company. The new company is actually one that I think will be attractive, okay? I don't watch a lot of TV, but I tell you what, this group of assets here from HBO to TNT to TLC to the Food Network, this is to CNN. This is a nice group of assets, and they are going to have a nice consolidated offering to offer consumers, especially in the direct-to-consumer trend that we're seeing in this space where people are paying a $5 to $10 to $15 a monthly fee to access content. This is a lot of content. And I think that consumers will be willing to pay up for these types of things. We've already seen it in the case of HBO. And even Discovery has their own offering of about, I think it's like $5 a month to access all of their networks as well. So I like what I'm seeing here. If you're an AT&T shareholder, me personally speaking, just from my own investing experience, I'm going to wait and see what happens with this one. I'm going to likely just take shares of the new company or potentially the dividend as well, because in both of those situations, I'm getting that value tax free. Whereas if you sell your shares now with AT&T, as with any investment, you're subject to capital gains taxes, especially obviously if you bought this at a much lower price and you're selling for a profit. The only thing that has me slightly wondering what's going to happen is this dividend rate. Is AT&T going to be able to maintain that? I think as we look through the financials, just at least on a surface level, it's more than likely AT&T will have the financial engineering power to likely keep this dividend at this rate, but I wouldn't necessarily expect strong returns on that or any type of growth on that in the shorter term, or even in the longer term as well. And the last question I think that we have is, now that Verizon and AT&T are kind of aligning their business models much closer to T-Mobile, what will happen to the multiples on these stocks? AT&T still trades at a clear discount to both Verizon and T-Mobile, not just on a price to sales basis, but nearly across the board. So liquidating this asset that many investors didn't want to be a part of could potentially raise the multiple on AT&T, and that could continue to drive this stock upward. So hopefully you guys enjoyed this video. Congratulations if you're an AT&T shareholder. The stock price is appreciated nicely, and I think this deal is a positive for AT&T. Thanks for tuning in today. Good luck with your investments.